Thank you for joining us to learn more about a time-sensitive tax opportunity for investing in renewables that has been created due to the COVID-19 pandemic and the CARES Act. As a reminder, the material appearing in this presentation is for informational purposes only and should not be construed as advice of any kind, including, without limitation, legal, accounting, or investment advice. My name is Eric Rohner, and I am a tax partner at Moss Adams. My practice is mostly focused in the renewable energy sector in helping clients, both developers and cash and tax equity investors, navigate the structuring and complex tax rules required to monetize the associated incentives. Let's get started. The reason for this webcast is primarily to highlight a tax opportunity to invest in renewables that was created by the COVID-19 pandemic and the resulting CARES Act. There's only a small window of time to take advantage of this opportunity. So if you were thinking about investing in a project, it may make sense to make that investment before the end of the year. In response to the COVID-19 pandemic, the President signed the Coronavirus Aid, Relief, and Economic Security Act, or the CARES Act, on March 27, 2020. Among other areas of relief, the CARES Act provided 4 key tax provisions that will be the focus of our discussion today. It temporarily restores the 5-year carryback of net operating losses that was eliminated by the Tax Cut and Jobs Act. It suspends the 80% of taxable income net operating loss limitation that came in with the Tax Cut and Jobs Act. It postpones the excess business loss limitation rules, also created by the Tax Cut and Jobs Act. And finally, it increases the interest expense limitation from 30% to 50%, created by the Tax Cut and Jobs Act. Under the CARES Act, NOLs generated in 2018, 2019, and 2020 can now be carried back to the 5 preceding tax years. So, for example, a loss generated in 2018 can be carried back to 2013. Any loss not utilized in the 5th preceding tax year would then carry over to the 4th preceding tax year, etc., until fully absorbed. For corporate taxpayers, this can result in rate arbitrage, considering that the maximum corporate tax rate applicable to tax years ending before 2018 was 35% compared to the current rate of 21%. You potentially could create a deduction in a 21% tax year and then carry that back to a 35% tax year, resulting in a permanent 14% tax rate benefit. But most importantly, the 5-year carryback provides a unique opportunity for both corporate and personal investors to take tax off the table in earlier years and receive immediate cash refunds. The Tax Cut and Jobs Act also limits the use of NOLs arising in taxable years beginning after 2017 to 80% of taxable income. So no matter what, you had to report 20% of taxable income. However, under the CARES Act, the 80% limitation is repealed for tax years beginning before 2021. The CARES Act also repeals the excess business loss limitation for overall losses added by the Tax Cut and Jobs Act. Under this limitation, an individual taxpayer's overall losses in excess of $250,000 or $500,000 for taxpayers who file jointly, after considering the passive activity loss limitations and the at-risk rules, are disallowed. The excess business loss rules are suspended for 2018, 2019, and 2020. Taxpayers who already filed in 2018 applying the excess business loss limitation rules can amend their 2018 return for retroactive application under the CARES Act. Finally, the Tax Cut and Jobs Act imposed a limitation on a taxpayer's ability to claim deductions for interest expense. Any net interest expense in excess of 30% of a taxpayer's adjusted taxable income, which is effectively equivalent to EBITDA, is disallowed. The limitation applied to any post-2017 tax year. Under the CARES Act, the 30% limitation is increased to 50% for 2019 and 2020. Partnerships, however, remain subject to the 30% limitation for tax years beginning in 2019. In addition, all taxpayers, including partnerships, may elect to use their ATI for a tax year beginning in 2019 to compute their Section 163J interest deduction limitation for their tax year beginning in 2020. Partners who are allocated excess business interest expense or EBIE, for tax years beginning in 2019 may deduct 50% of that EBIE in tax years beginning in 2020. The remaining 50% of the 2019 EBIE is subject to the normal Section 163J rules, meaning it's carried forward to tax years when the partners allocated sufficient excess taxable income, or ETI, from the partnership. So the opportunity is really twofold. The first is just the normal consideration of the changes to the Tax Cut and Jobs Act from the CARES Act. The CARES Act will allow taxpayers to claim increased deductions that will lower their taxes they would otherwise pay, or the increased deductions could create refund claims either from amending prior year returns or by creating net operating loss carryback claims. But 2018 and 2019 years are already in the book. Aside from the deduction increases and net operating loss carryback opportunities in 2018 and 2019, 2020 presents a soon-to-be closing opportunity for taxpayers to invest in a renewable energy project. For example, a taxpayer invests in a project in which the equipment is placed in service in 2020 may be able to claim 100% bonus depreciation on that asset. If the deductions result in a net operating loss in 2020, that net operating loss can be carried back to 2015, allowing the taxpayer to claim a refund of taxes paid in that year. Any net operating loss not absorbed in 2015 would carry over to each successive tax year until fully absorbed. Further, any credits, such as investment tax credits or production tax credits, generated in 2020 that would not be available to be used in 2020 because the taxpayer generated NOL in the same year, would be available for a one-year carryback to 2019 under the current rules. If a taxpayer is able to absorb 2018, 2019, and 2020 NOLs and credits through carryback claims to earlier years, not only do the carryback claims provide immediate cash refunds, they free up the taxpayer's ability to absorb future tax benefits in years beyond 2020, truly making 2020 a unique opportunity for investing in renewable energy projects. Thank you for listening to this webcast.